All right, good afternoon, everyone. This is Joe Bacella here at Chaiken Analytics, and I'd like to welcome you to our presentation of Turn Volatility into Profits, the key of investing in this chaotic market. Presenting today is Marc Chaikin, founder and CEO of Chaiken Analytics. As a reminder, this webinar is being recorded, and a copy will be sent to everyone who has registered. Please submit your questions using the Zoom Q&A window, which is available in the upper left-hand corner of your screen. Now, Marc Chaikin created Chaiken Analytics to put the power of proven stock research tools in the hands of professionals and individual investors. His latest contribution, the Chaiken Power Gauge Rating, is a proven 20-factor model that uniquely combines fundamentals and technicals. To get us started, here's Marc Chaikin.
Thank you, Joe, and welcome everybody. A little bit of my background, 50 years on Wall Street. I actually took 10 years off, so I may be exaggerating because 40 active years on Wall Street. For 45 years, though, I've been using technical analysis in conjunction with fundamentals to help make sense of the market. And in the volatile climate that we're in right now, technical analysis can really provide some guideposts to help you make sense and deal with the volatility. I've survived 10 bear markets, so as the Farmers Insurance commercial goes, I know a thing or two because I've seen a thing or two. And we're going to share some of that knowledge with you on today's webinar. Along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were colleagues and some of them were clients. And the reason that's important is that everything I learned from these very successful active portfolio managers and hedge fund traders, I synthesized down in a research project that spanned about 15 months to something we call the Chaiken Power Gauge Rating. It's the culmination of my life's work. It's something I always dreamed of doing. And I came out of retirement to start Chaiken Analytics 8 years ago with my wife, Sandy, to bring the power of proven analytics to the individual investors and to advisors who were not getting what they wanted from their firms. So we're going to share the Power Gauge Rating with you. It's our fundamental indicator. We combine it with technicals. And in the next 45 minutes, going to show you how to cope with volatility and profit in a rising interest rate environment. So you've got to know what to expect in the weeks and months ahead. We're going to tell you that from our perspective. Show you how to find winning sectors, groups, and stocks. Very important, avoiding losers. Volatility can create great opportunities. Going to show you how to seize that opportunity with confidence. And you do that by buying on extreme reactions or using disciplined entry and exit signals. I'd like to start off with a poll, and the question we want to propose today is, how is stock market volatility affecting you?
All right, we'll give that just a few minutes. If you don't mind, take a moment, go and respond back. So regarding the recent volatility, what do you make of it? Are you looking at it as an opportunity? Is it making you nervous? Or are you moving to the sidelines? We'll give you about 5 seconds and we'll take a look at the results. And let's take a look. All right, Mark, looks like a lot of people are eyeing up an opportunity.
And that's very consistent with what we've been saying in our Chaiken Market Insights, our weekly newsletter. So we're pretty much of the same mind. And for those of you who view it as an opportunity, we're going to show you how we take advantage of it, how I take advantage of it. My wife, Sandy, who manages her own 401k plan and does webinars as well. So let's take a look at the market and just walk through what's happened here in the last 2.5 weeks. This is a one-year chart of the SPDR, the SPY ETF that mirrors the S&P 500 index. It's the most actively traded instrument in the US markets. In that January rally to the peak on January 26, $69 billion flowed into the SPY. A lot of this was money from people who were on the sidelines, who were unconvinced of the bull market. But when we broke above that upper channel, greed took over, and something they call FOMI, fear of missing out, took over. And then we got a sharp decline, as you all know. Now, what triggered that decline may affect how we form the lows and where we go from here. But as you can see, we came down to a trend line from the bottom in it actually is the bottom in February of 2016. This is a shorter term trend line. They come in at the same spot. And we rallied back up on Friday before the holiday weekend to the top of that channel and ran into resistance. For those of you who look at Fibonacci retracements, 0.618 retracement, rallied up to a resistance level. And then today we came down, and we came back down through the 50-day average. So as we're going to see in the next chart, and we see from this chart, we've gone from an uptrend that was on autopilot to a roller coaster of a correction. And a correction is defined as a move in the S&P 500 index of more than 10% on a closing basis. Now, corrections and pullbacks, which are defined as 5 to 10%, end in two ways. The shape of the letter V, and that is what encourages the buy the dip mentality. And all through this bull market, buy the dips has been the watchword. However, as you see in the middle of the chart, in late 2015, that was August, September, and then again in early 2016, January, February, we formed what are called W-shaped bottoms. You make a low, you rally up, then you come back down and test that low. Now, W bottoms historically have been the way corrections end, meaning you go down more than 10%, almost invariably you form a W. Now, will it be different this time? Are we going to form a V shape or a W shape? Well, we rallied up exactly the way we did in 2015, stopped at the exact same retracement level, 0.618. Now we pull back below the 50-day average. So I rated the odds 50-50 in my weekly market letter on Sunday that we would form a W bottom. The reason it wasn't 100%, which is what I was thinking, was that this rally and then this decline rather was triggered by a very odd event, a highly volatile, highly leveraged instrument used by hedge funds and commodity trading advisors to enable them to bet on low volatility strategies. And they ran into margin calls. There was a tirade of selling. And so it's very possible that we've seen the lows, but the key reference points are the 50-day average. We broke that. Below that, it's the 100-day average at 26.50. And below that at 25.50, you're looking at the 200-day average. And if we go down and test the lows, we'll either test the 200-day average or the closing low of 25.81. I can't tell you whether it's going to happen. I'm going to try and convince you in this webinar that it doesn't really matter. You've got to take advantage of opportunities. We think the bull market is alive and well. But before we get to that, let's put pullbacks into perspective. This graph shows what's happened since 1945, so 73 years. You've had 75 declines, roughly one a year of 5 to 10%. We had none in 2017. That's why, with the market so overextended in January, we were ripe for a pullback. It turned into a correction. The good news about pullbacks is that they're over relatively quickly. They average 6%, typically take a month to 6 weeks, but then you recover back to new highs within a month. So they're relatively painless, and we're going to show you some entry techniques that you can use to take advantage of pullbacks. Now, 10 to 20% corrections, and there have been 27 of them in 73 years, so roughly once every 2.5 years, they last longer. So this one has only lasted 2 weeks. They typically last 4 months, and then you recover to a new high within 3 months. So the jury's still out on this because of the compression. The time to drop 10% was only 9 days. It's the shortest drop in history of 10% or more in the S&P 500. We may very well see the time, if we do form a W bottom, be compressed down into the 1.5 to 2 months range. But the bottom line is these are buying opportunities. They're not reasons to be fearful. Another way to look at the landscape as it's going to play out is to look at the number of stocks making new 52-week lows on the New York Stock Exchange. 791 of them in the week that ended February 9th. It's an extreme number. Typically, when you're down 10% and the number of new lows is at a maximum extreme, you have to rally like we did and then come back down and test the lows. So the odds favor that, except for the very, very unusual circumstances that triggered the decline. Now, here's what's really important to focus on in 2018. The trend of corporate earnings. They're up. That's why we remain bullish in this volatile market. Fourth quarter earnings season ended today. Walmart had a very disappointing report. That's part of what contributed to today's selling. Worst day for Walmart since 1988, by the way. But the trend of corporate earnings has been very, very, very strong. And companies have been telling Wall Street analysts and the public that they're going to do better than expected in 2018, aided by the tax cut and a little bit of a spending boost out of Congress. Corporate earnings are just going to be fabulous. This is a great environment for stock prices. Interest rates going up. That was used as an excuse for why the market was weak, because they went up too fast. So in this climate, you need to focus on strong sectors and industry groups and know which ones to avoid. And at the end of the day, in a period of rising interest rates, stock selection becomes very important. Studies have shown that active portfolio managers, as opposed to passive index funds, do better in a period of rising interest rates. Their analysis of stocks vis-a-vis the cost to borrow and so forth becomes more valuable in a period of rising interest rates. Now, this is a chart of the TLT. This is the 20-year Treasury bond, rather, and it's an ETF. And you can see it made a new low today, which means yields are moving up. The key, though, is that rising interest rates are not bearish unless they rise very, very, very fast. The Fed has already told us that they're going to raise interest rates 3 times this year. It shouldn't be a surprise. They've done one already. So this didn't come out of the blue. That's why I think this unusual event that triggered the decline may mean it's different this time, although that's the one phrase you should always shy away from. You hear someone say it's going to be different this time. As you'll see in the course of this webinar, patterns on Wall Street repeat over and over and over again. The reason is that the swing of stock prices from overbought to oversold and trends that persist for extended periods of time are a function of human emotions, and human emotions haven't changed in 100 years. So the scenario for 2018 is a very bullish one. The upper right, this is courtesy of Bank of America Merrill Lynch, higher rates and rising earnings is a bullish prescription. It means the economy is strong. It means that companies are reinvesting in their own businesses. We're going to get a lot of buyback and M&A activity because of the repatriation of cash and the additional cash that companies are going to throw off because of the lower tax rates. It's a very bullish scenario. So what happens in a period of rising interest rates? Well, there are certain sectors on the bottom left, circled in green, that do well. Financials, industrials, technology, materials, and energy typically. And then there are certain sectors that historically have done poorly. Utilities, consumer staples, real estate should be in there. It's recently been broken out as a sector in the S&P. So let's see what's been happening to see if the current market environment is actually following the script. And in fact, it is. This is something we call our Chaiken power bars. You haven't seen the Chaiken power gauge rating yet, unless you're a Chaiken subscriber or a member. But we sum up the fundamental rankings for each stock in an ETF or an index or a list, industry group. And we create what we call the power bar. And the power bar tells you the potential of that sector to outperform or underperform the market. And it's holding almost 100% true to form. Financials, industrials, and technology, 3 of the top 4 based on the power bar potential. That's the difference between the number of stocks with a bullish rating and a bearish rating. And then at the bottom, consumer staples, real estate, and utilities exactly where they should be. Bearish potential in a rising interest rate environment. So we're going to zero in on stocks in these groups and these sectors that you can really benefit by owning and buying on this extreme volatility and weakness that we are seeing. But if you're of a belief that we're going to test the lows, here's a wonderful options trade. Comes from our options play module that we license and put into Chaiken Analytics so that Chaiken members can find options strategies that are probability based in the same way that the power gauge rating tells you the probability of a stock outperforming or underperforming the market. So let's say you think that we're going to go down and test that 2580 level. This is what's known as a bearish vertical put spread. We're using the SPY, so very liquid, very small spreads between the bid and ask. And when the index was down 0.25% and it closed down 0.57, you could have bought the March put that expires on the 29th of March, so a good 5.5 weeks away, with a 273 strike price, and sold the 259 put against it. So you reduce the cost of that put from $578 to $346. Those of you who are options traders and understand this position, please type a big O in the question box. We like to gauge the audience and what your interests are and how we're resonating. So this position, when it was possible to put it on at about 10 o'clock this morning or 10:30, gave you the potential to make a 300% return on limited risk of just $346 per 100 shares of the spider. 300% return if the index went back down and tested that 2580 level by March. So really nice trade. If you've got a 401k plan with $270,000 in it, you want to stay fully invested, but you want to try and hedge against a test of the lows or even worse, for $3,500, you can hedge that portfolio, a little more than 1%. If the market rallies out of here and goes up 6% to a new high, you're participating, but you protected your portfolio against a 4.5% drop. So this is a great way to play defense, which we're going to talk about later in the webinar. Now, we've already covered a lot of ground. We talked about interest rates. We talked about W and V patterns. We talked about earnings and so forth. That exemplifies one of the biggest problems we have as traders and investors. There's too much information. We're in the era of information overload. And the key to making money in the stock market, whether you're a trader or an investor, is to be focused. Information overload takes away your focus. The talking heads on CNBC, the headlines in the newspaper, the tweets that we're all so dependent on, information overload to the max. On the right is what fundamental data looks like. I'm a firm believer that you need to look at both the fundamentals and the technicals. I couldn't make a decision based on what's on the right, but a lot of fundamental analysts do. So what we've done is to cut through the clutter, synthesize all that information into the Chaiken power gauge rating, and there's an example of that on the left. That's an old power gauge display from Lam Research back in March of last year when the stock was 127.80 with a very bullish rating heading up to 220. So the Chaiken power gauge rating is really our secret sauce. And what we've done is to wrap it in a solution that we call Chaiken Analytics for both iPad and desktop, and we'll be using charts from Chaiken Analytics as examples of what you can do and the way we do it. So this is twofold. Show you what we do, convince you that you can do it as well. Now, along the way, we've garnered some nice kudos. Some of our old institutional clients like Soros Fund Management, hedge fund, Fidelity Investments, Paulson, one of the biggest hedge funds, have subscribed to Chaiken Analytics, become members, but also people you know like John Najarian and Jim Cramer and John Carter at Simpler Trading have embraced the whole power gauge concept. I just did a wonderful 1-hour private webinar with Jim Cramer 2 weeks ago, and it was well received, and it was great to be on camera with Jim just talking about stocks. So what we're going to do in this webinar is to help you find stocks like Red Hat. Red Hat's a software company. They make open source software. Opportunities to buy the stock ahead of earnings reports. We're going to explain in a minute why earnings season is so powerful, why you make so much money. And even recently with the power gauge neutral, we got what's called a relative strength buy signal. We have 6 pairs of buy and sell signals in Chaiken Analytics, and we're going to show you them in depth here. So plenty of opportunity, and these are the type of stocks that you can identify with a disciplined approach. So here's a slide that I've been using for 5 years in webinars. And boy, hasn't this been the case here for the last 2.5 weeks. Fundamentals drive the market, but emotions drive the market to extremes. So for me, the path to profits has always been, for 45 years, a combination of fundamentals and technicals. And the power gauge helps you conquer emotions because it synthesizes all of that data down into a gauge that you can come to believe in and trust by combining fundamentals with technicals into a quantitative model, and then giving you Chaiken buy and sell signals for better entries and exits. We call this the Chaiken directional edge. If you're an options trader or a swing trader, this is absolutely critical because your best trades, the highest probability win-loss ratio will come if you're trading in the direction of the fundamentals. So particularly in a period of highly volatile market action, successful trading and investing demands a disciplined methodology. This pyramid encapsulates that. At the top of the pyramid, the power gauge rating. That's our go-to indicator. We also think sector and industry group strength are very important. You saw that earlier because in rising interest rate environment, certain sectors do well historically. We're talking about 35 years of data, not just 6 or 7 years of data, and certain do poorly. At the bottom, just 2 technical indicators. It can be as simple as 1, 2, 3, power gauge rating, relative strength, Chaiken money flow, and then that sweet spot, the buy and sell signals. So the power gauge rating looks very simple. We designed it that way so that individual investors could get a quick read on any one of 5,000 stocks. And very soon we're going to have power gauge ratings for exchange traded funds, combining fundamentals and technicals. And you'll be able to do that for ETFs as well. But please don't confuse simple with simplistic, because under the surface, there's a lot of number crunching going on. There's a lot of data-driven analytics that go into the power gauge. And you'll see the factors in a minute. I've said more than once on these webinars that the Chaiken power gauge rating is like a Chevrolet with a Ferrari engine under the hood. And it can be your GPS during earnings season. And that's really critical because there are terrific opportunities during earnings season if you have a sense of that directional edge. Which is a stock likely to report better than expected earnings like Red Hat did, or disappoint? So Jim Cramer has become a big fan, as I said. We did a live teach-in in New York. People actually paid $300 to attend, see the very similar presentation to what you're seeing now. And Jim said, Chaiken Analytics model is the best, used it at my old hedge fund. And that's when we were explaining the factors. So what's in the Chaiken power gauge rating? Well, 4 primary factors that look at value, growth, technical, and sentiment indicators. And then there are 5 sub-factors in each grouping. The value metrics are 35% of the model. Free cash flow to market cap is the highest weighted factor. They're not all equal. If that sounds like Warren Buffett, it should, because that's what he looks at and has for 50 years. And price to sales ratio. If you pay too much for a dollar of revenue, think 3D printing stocks, cloud computing stocks. Any fad pushes stocks beyond a reasonable number price to revenue. In growth, which is what Jim Cramer would tend to look at, I've boxed earnings surprise, because during earnings season, companies either meet or disappoint. And when that happens, one of my mentors, George Douglas at Drexel Burnham in the mid-'80s, did the original research in earnings surprise and earnings estimate revisions. Earnings surprises come in bunches. That's part of the reason the power gauge works at predicting stocks that will outperform over 3 to 6 months and beyond. Because earnings surprises come in bunches. There's never just one of them. So company reports a string of earnings surprises. Analysts are raising their estimates. And analyst estimate revisions are the single biggest short-term driver of stock price movement. Because Wall Street really hasn't changed in 50 years. The big investment banks like Goldman Sachs, Morgan Stanley, UBS, Merrill Lynch, they all have an influence, Raymond James on a more regional note, they all have an influence over institutional investors when they change their earnings estimates. So we model that in the Chaiken power gauge as well. And then I've boxed industry group relative strength because we're going to zero in on some of the strongest sectors and industry groups in this webinar. Puts the wind at your back. Now, in 2015, everybody's saying we've been in a bull market since '09. We actually had a bear market in 2014 into 2015 that ended in February of 16. And the bear market was in small cap stocks and energy stocks. So this is the performance of the power gauge rating using the Russell 3000 as the universe in 2015. The very bearish stocks, there are always 428 of them, were down over 17%. These were the energy stocks, the fracking stocks, the rails that move all this liquid around, small caps in general. So it was very important to know which stocks had bearish potential. We're going to zero in on one of them. Very critical stock, Under Armour, in a minute. Because if you could avoid those bearish stocks and not bottom fish, then you're really improving your performance right out of the box. So one final proof point, we have partnerships with NASDAQ and New York Life Index IQ ETF subsidiary, New York Life being the largest mutual insurance company in America. 4 years ago, we created 3 NASDAQ Chaiken indices, large cap, small cap, and dividend achiever. The power gauge was the final criteria for what stocks made it into the index. And these are buy and hold indices that rebalance just once a year on April 1st. So it's not a trading index, it's a buy and hold index. And all 3 of these have significantly outperformed their benchmarks. And because of that, New York Life's Index IQ subsidiary licensed all 3 indices in February of 17 with the intent of rolling out exchange traded funds. 2 of them have been rolled out. The small cap rolled out in May of 2017, the large cap in December. Now, just a disclaimer, this is not a recommendation to buy these indices. This is just validation for the power gauge rating so that you come away from this webinar believing that there is a tool that can help you know the fundamental potential for a stock, but doesn't require you to slave all weekend or at nights to figure out what that is. Between those 2 ETFs, there's over $660 million that's using the Chaiken power gauge to guide the ETF constituents. So really powerful validation that this works. So let's zero in on some profitable patterns. The first one we call the classic Chaiken bull. Again, just 3 steps. Power gauge rating is bullish, meaning the fundamental potential is strong. The stock is outperforming the market. That's absolutely critical. And Chaiken money flow is strong, telling you that the institutions are accumulating the stock. So this was our poster child until just about a month ago for a classic Chaiken bull. Cigna, relatively conservative insurance company. Power gauge rating was bearish for over 15 months, starting at about 128 on the way up to 220. And I like to read this chart from the bottom up. So let me walk you through this. Power gauge rating, our fundamental indicator, is a ribbon at the bottom of the chart. So that's where I start my analysis. I only want to trade on the long side with stocks that have a bullish power gauge rating. I then want the market to tell me I'm right. I call this the market and the model agreeing. Because no matter how good your fundamental research is, if the market disagrees with you, guess who wins? Mr. Market always wins. And then I look at the Chaiken money flow to see if the institutions are accumulating the stock. And in the main, these big mountains of green tell you that Cigna, because Chaiken money flow typically fluctuates from red to green, but when you have these periods of 2 or 3 months where Chaiken money flow stays green, even with a pullback, and that's a very powerful pattern, by the way, it tells you the institutions are accumulating the stock. Now, the final piece in here are these signals. In this case, it's our oversold buy signal. They work about 2 out of 3 times. They're more of a trading entry for swing traders and options traders. The signal tends to last 5 to 10 days, and you'll usually go up to the upper volatility band off a signal like that and run into selling pressure. Very good signal, and it's so simple. I learned this from Larry Williams, who's sort of my long distance mentor. When I created Money Flow, I borrowed some of his ideas back in the 70s. So how do you get an oversold buy signal? First of all, the power gauge has to be bullish. There's your directional edge. Stock has to go down and get oversold and make a new 8-day low. So this is sort of trying to catch the bottom, oversold buy. That 8-day low triggers the buy signal. We have other signals that trigger when you get a pattern and then reverse back to the upside, and we'll show you them in a moment. So this is your classic Chaiken bull. Now the power gauge is neutral. Cigna is underperforming the market. Chaiken money flow is red, so we no longer want to put this on our bullish radar screen. Take it out of the bullish watch list. If you were still long the stock when it broke the long-term moving average for the first time in a year, as the market did as well, you want to get out and take your profit. If you were fortunate enough to get in at 140 or 160, you rode it up to 220. Not bad getting out at 208 when you know the stock's then come back down to 185. Now, it's one thing to know that a pattern works, but how do you find them? So in Chaiken Analytics, we've got a unique stock screener. We've taken some of the best functionality from the screeners that are out there, and then we've made it even better by giving you access to the power gauge rating and the 20 factors within the rating to screen on. So in this case, a week ago, 10 days ago, on the 8th, for a webinar that I did, day before the market was bottoming out, started with the S&P 500, screened for bullish power gauge ratings, strong free cash flow. There's the Warren Buffett effect, because in a volatile market, you want to go for quality, and free cash flow is a great measure of quality. I was looking for stocks that were oversold with relative strength positive, meaning they're outperforming the market. Narrowed the S&P 500 down to just 30 stocks. Two of them, JP Morgan and Michael Kors, we're going to look at in this webinar, but there were other really good buy candidates here to buy on further weakness, which developed the next day and then again the following week. So the mirror image is classic Chaiken bears. Power gauge rating bearish, underperforming the market. Chaiken money flow red, not green, telling you that institutions are selling the stock. So here's Under Armour. Up until recently, the power gauge was bearish. This chart is through yesterday's trading, or today's trading actually, and the stock went nowhere while the market was making new 52-week highs. Continued to underperform the market until last week, when it spiked up in the hope better than expected earnings report was a signal that the tide had turned. I'm a big believer in not bottom fishing. I believe bottom fishing is the most expensive sport in America, so I don't like to do it and don't want to see you do it. Because for every time that you're right, there'll be 5 times that you're wrong. And when you're wrong, you don't sleep well because you don't know what to do. Now, Under Armour is not a newcomer to a bearish rating. In fact, this chart, which ends in June of 2017, so it starts in July of 16, shows that the power gauge turned bearish when Under Armour was 40 on the way down to 12. That shows you how dangerous bottom fishing is. And along the way, we got what we call our relative strength sell signal. Now, this is a powerful signal. It requires that the stock be underperforming the market. It actually works best when the power gauge is also bearish, but it can trigger without that. And the stock moves back above its 21-day average and then drops below. So this is a pretty powerful pattern, because you have a weak stock that's rallied up and then started to reverse that rally. And this is a powerful signal on both the upside for relative strength buys and the downside. And notice that back in 2016, with the stock in the 38-40 area, what were the institutions doing? They were selling the stock. How do we know that? There's no green for 8 months in Chaiken Money Flow. By the way, you can get Chaiken Money Flow on your online brokerage platform. Stockcharts.com has been featuring it for 30 years. Well, 20 some odd years since it's been in business. What we do at Chaiken is combine everything you need to know on one chart. So you don't have to go to Investors Business Daily to find relative strength, somewhere else for fundamentals, stock charts for money flow. We put it all on one chart with the signals. That's how we help cut down information overload. Focus, the key to making money in the market. So 3 other patterns I want to expose you to. They're very powerful. The last one is a secret we've been teaching professional traders for over 30 years. But the first one is the dynamic duo. Second one we call personality changes. The third one, stealth accumulation and distribution. And this pattern we're going to share with you, which we reinforce 4 times in the webinar, is really the ultimate pattern for getting out of a stock near its high. So what is the dynamic duo? It's the combination of the Chaiken power gauge rating to monitor the fundamental potential and relative strength to tell you whether the market agrees and the stock is outperforming. When they agree on the upside, big winners. When they agree on the downside, you tend to get big losers like Under Armour. One caveat, relative strength can stand alone as a bullish or a bearish indicator. When it does, on the upside, these are what's known as momentum stocks. And if you're trading a momentum stock from the upside or it's in your 401k plan, in my view, you're on a high wire without a safety net. So you've got to be very sensitive to something going wrong, because if you fall off that high wire, extremely painful financially and emotionally. And we're going to see a dramatic example of that on the downside in General Electric when we look at playing defense. So here's an example where the dynamic duo is bullish on the upside. Centene in the Medicaid business, they've done everything right, even when healthcare stocks were doing poorly. Centene did well. So reading the chart from the bottom up, power gauge rating is bullish, stocks outperforming the market. Chaiken money flow is consistently green, telling you that the institutions are buying the stock. And you've got 4 relative strength buy signals. Now, the good news that I didn't tell you is that a relative strength signal lasts 4 to 8 weeks. It's a phenomenal signal for swing trading. It's a great place to establish a position for your 401k plan. And you can use options without being under the eroding premium gun, because you can buy longer dated options knowing that you're going to be able to ride a couple of swings up. Now, can you see that, how the overbought, oversold signals lasted just 2 weeks, but these signals are really powerful, and the duration is what makes them extremely profitable for traders. Now, notice this big gap in the middle of the chart. We're going to talk about gaps in a minute. Great way to get out of a stock if you're a trader or a swing trader. You may leave a little on the table, but normally you're selling when other people are buying, sort of Warren Buffett. You want to be greedy when other people are fearful, and fearful when other people are greedy. You get a gap up like that, that's greed. They announced an acquisition back here, and that acquisition is still pending. It's going to add 1.9 million people to their Medicaid rosters, making them the largest Medicaid provider in America. And in case you think Medicaid's a bad place to be, guess what Centene did? They raised their rates last year in anticipation that the government might cut their subsidies to poor people. So they hedged themselves. Very smart management team. Now here's dynamic duo on the downside. AvalonBay, it's in the real estate group. Interest rate sensitive. They're one of the groups that do poorly in a rising interest rate environment. When does this stock start to go down in earnest? When interest rates start to go up in late August and early September. So power gauge bearish. Relative strength goes from green to red. You'll see in a minute, we call that a personality change. And then you get these money flow sell signals. Third one I'll explain to you. Power gauge is bearish. Money flow is negative. Stock rallies above a short-term moving average, think 8-period exponential, and then drops back below it. And there's your signal. So even after 2 very positive signals, this last one right ahead of earnings proved to be very profitable. The stock dropped from 170 all the way down to 155. You want to avoid these stocks and look for opportunities on the short side using put options. Now, spotting personality changes, I've often said, is perhaps the most important key to keeping profits and being on the right side of trades. Personality change is defined as a stock that's been outperforming the market, so the relative strength is green, that begins underperforming the market. Relative strength is red, and vice versa. And the reason this is so important to know about and be able to spot is that the worst thing you can do on Wall Street as a trader or an investor is to put your feet in cement. To fall in love with a stock like Under Armour or Kinder Morgan or AvalonBay and not recognize that the market has turned on you. And it also works on the upside, as you'll see in this chart of Michael Kors. Now, Michael Kors was in a downtrend. And then you got a positive earnings surprise and the stock spiked up. The power gauge had already turned bullish, and look at the institutional accumulation here. But it broke the downtrend in a big way, and then you had that bullish personality change because of that. Now, you don't want to buy the spike. The same reason you want to take profits on a spike. says you want to wait for a sideways to down action of 3 to 8 days when you get a big momentum breakout. But you do want to buy the first buy signal. So you got an oversold buy about 8 days later. That enables you to get into Michael Kors around 43 on the way to 70. And then you got another signal about a month and a half later. Now, more recently, you got a buy signal ahead of earnings. These are the oversold buys. And look what happened. In the middle of this waterfall decline, those earnings were so strong and there were so many short sellers in the stock that Michael Kors spiked up to $70, made a new all-time high. And then it succumbed to the weight of the decline and sold off all the way to 56. Well, that sell-off was your second buying opportunity. You could have bought ahead of earnings and then sold the spike, or you could have waited and with that waterfall decline, taken advantage of that. Now, I don't think you would have bought it at 56. You might have bought it at 60 and had about 20 minutes of pain when the stock just tanked, but it rallied all the way to 64, trading at 63.25 today. So there's your personality change and how you take advantage of it. Now, on the downside, I'm not going to be able to use this stock in about 6 weeks because this personality change to the downside isn't going to be on the chart anymore. But we've been using this for over 6 months in our webinars. Bearish personality change, the power gauge is bearish, so read it from the bottom up. Bearish power gauge, underperforming the market. Look at the institutional selling in this drug stock. And then along the way, overbought sell signals. All of them profitable, but notice 5 to 10 days duration. There's shorter term signals for swing traders or options traders. Now, here's the signal that if all you learn from this webinar is how to spot this signal, and we'd love you to become members of Chaiken Analytics where we make it easy to see it, but if all you learn is this signal, which 95% of traders never see, you can be profitable trading for the next 20 years. So what is the signal? We call it a bearish money flow sell alert. And we're looking at a 1-year chart of advanced auto parts that ends in May of 17. Now, we actually turned bearish on this stock and 2 other stocks in the group in one of our April market letters based on the fact that the stock was making new 52-week lows and the market was making new 52-week highs. So what is a bearish money flow sell alert? If a stock rallies up and equals or exceeds its old high, forms what we call a double top, and Chaiken money flow stays red instead of going green, which is more normal, that means institutions are selling. Smart money is getting out under the cover of strength, and you want to do that as well. It's a great spot to get out of a long position. Notice the power gauge was neutral. It was a high momentum stock that spiked up on an earnings report and then couldn't attract new buyers. So here's an example of a bearish money flow sell alert. Now this chart ends at 130. You had just had an overbought sell signal ahead of the earnings at 150. It was trading at 130. The ultimate low was 78. So the bearish personality change combined with all 3 of our key indicators being negative gave you the opportunity to put on put positions over and over and over again ahead of earnings. Now, everything we've been looking at, we call the ideal setup. All 3 of those indicators from the bottom up and a signal is your final piece. Warren Buffett calls it the fat pitch. He's famously said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. We call that the ideal setup. The missing piece are the signals. Remember that sweet spot in the middle of the pyramid. So we're trying to give you entry points that will help you pull the trigger, because doing and spotting all these wonderful opportunities means nothing if you can't pull the trigger. So 6 pairs of buy and sell alerts. We've been through 3 of them. And again, we make it easy for you to find them. This is from our iPad app. It's on our desktop browser-based version as well. Every day in any list, but particularly in the stocks that you're following, we call that your My Stocks list. We show you the stocks that have triggered bullish or bearish signals. Back in August for a webinar, these were the signals. So on the upside, let's zero in on Trinity Industries. We have been showing Boeing, but we're going to show that later. and Bed Bath & Beyond. So here's Trinity Industries. They make pipe for the steel industry. And here's where that buy signal came in. Stock was trading around 28. Notice that it spiked up on some very good piece of news. That's where you exit the trading position if you've hung on. You can always buy it back. And then look what happens at the top. Bearish money flow sell alert. So the stock's gone from 28 to 38. That's a nice 38% rally in a market that was up only about 18 or 19%, double the market. But more importantly, if you hung on, or if you had traded back into the stock, you got a bearish money flow sell alert. Again, new high, money flow stays negative. Notice how it goes green and the other moves. This is unusual, and it's also a very powerful signal. And we'll show you one more example of that in a little bit. Now, here's signals on the downside. Bed Bath & Beyond had triggered a relative strength sell signal on August 10th right here. It came in the middle between two relative strength signals that came about a week before earnings reports that disappointed. That's why these signals during earnings season are so powerful. You establish a put position. We like vertical put spreads as your highest probability way to participate on the downside. That limits your risk to the cost of the spread. And if you get a bearish earnings surprise, you'll get a spike down normally, and that's where you take your profit. But in the middle of that, there was also a profitable relative strength sell signal. These work about 70% of the time. Very powerful signal for traders and also for investors looking to exit the stock after a rally. Now, we want to cover defense because good defense is really important and it can lead to good offense. So how do you play good defense? Well, first of all, you avoid weak industry groups and weak sectors. You don't bottom fish. You eliminate bearish rated stocks from your portfolio. It's the last thing you want in a 401k plan. And you use put options to protect your portfolio. We saw an example of that with the SPY put trade. So here are some stocks that you didn't want to own in 2017. You played good defense by getting these out of your portfolio and then turn that into offense by looking for put opportunities. So Allegan Pharmaceutical, very weak stock, bottom up, power gauge bearish, underperforming the market, institutions selling like crazy. It had a spike rally, it went from 218, 217 actually, up to 233. I made it my bearish stock of the week in our weekly market insights that comes bundled with Chaiken Analytics. 233 down to 160 in 2.5 months. And then a second signal up here, same signal, overbought sell with the stock rallying from 160 all the way up to 190 and then collapsing and making a new 52-week low. This is how you make money by playing good defense. You find opportunities on the short side. You get these stocks out of your portfolio. There are a lot of institutional investors. A very good friend of mine who you all know unfortunately stayed long, Allegan. Now that he's watching the Chaiken power gauge, he may have a different view of these stocks. And here's another stock you didn't want to own, General Electric. Now the power gauge was neutral, but look at the relative strength. Remember I said earlier in the webinar, relative strength stands alone as a bullish or bearish indicator. So if you see that relative weakness in General Electric under the long-term moving average, institution selling, when you see that relative strength sell signal, jump on it. If you're long the stock, just get out. Don't think twice. There are 5 of them on the chart. There's one over here you can't see above 28. You see how well they work out and that time duration of 4 to 8 weeks. It's a wonderful trading entry signal. Now, Chipotle, another darling, is probably the most loved fast food stock in 2016 into 17. Bearish money flow sell alert over here, covered up a little by the icons as the stock rallied up to 490, 500. When you made the double top, money flow stayed negative. Then you had bearish personality change, power gauge going bearish. So again, reading the chart from the bottom up, power gauge bearish, underperforming the market, institutions selling, momentum breakdown when you go below the volatility band, and the stock goes all the way down to 260. Now the power gauge actually turned bearish on Chipotle at 690, down from a high of 710 before the E. coli crisis hit back in 2016. So this can be a very, very wonderful way to exit trades, to know that the game is over and look for downside opportunities. And then finally, in the playing defense category, DR Horton. This is one of our favorite bullish stocks of 17. Home builder that caters to first-time home buyers who are in the market like crazy. And I made this my bullish stock of the week again in September, about a week after Allegan was a bearish stock of the week. It was 36.50. It had triggered some buy signals. I didn't jump on those in my market letter, but I did see the institutional accumulation and a little bit of a pullback to the 21-day average. Made it my bullish stock of the week, went all the way from 36 to 53, and lo and behold, look what happened at the top. Bearish money flow sell alert. Can you all see that pattern? If you can, put a big SA for sell alert in there, please. And Joe, are we seeing people understanding this pattern?
And I'm looking for, and here come a few responses right now. I think there was just a bit of a log jam, but yeah, we're seeing a lot of SAs come through.
Well, if this is something you want to explore in depth, become a member of Chaiken Analytics. Joe Bacella does 3 onboarding sessions every week and does a pre-market a couple of times a week. So you can learn about this and ask your questions, but it's a powerful, powerful technique. And notice that after the money flow sell alert, you want to ignore the next oversold buy signal. If smart money is getting out here at the top, you don't want to be dumb money and go back in on the first dip. You want to wait a bit, even though we still like home builders. Housing numbers on Friday were fabulous. Got to wait. Now, you can profit from volatility because volatility creates opportunities, particularly if you're looking to buy stocks with bullish power gauge ratings at distressed prices. So here are 4 stocks. 3 of them were on my wife Sandy's buy list heading into Tuesday's opening on February 6th. JP Morgan. Remember I said earlier you want to buy quality in volatile periods. So you're looking for stocks with bullish power gauge rating, outperforming the market, Chaiken money flow, and strong industry groups. Finance was one of those groups that does well in rising interest rates. So you got a oversold buy signal. You could have bought that when we said put a third of your cash to work on Tuesday morning, February 6th, or waited for the signal, either or both, and you got into JP Morgan around 106 and saw it rally to 115. And this is the premier bank in America. AbbVie spun out of Abbott Labs, combination of biotech and drugs, really fine stock. Bullish personality change back here in late April with the stock at 68 on the way to 120. Everything from the bottom up reads well, and you're looking for these buy signals. My wife Sandy bought it on a limit order. She put in a limit under the market at 102, figuring if I can buy it at that price, and it hasn't been there for a month and a half, and she got it. And when she got the fill back from Vanguard, guess where the stock was? It was 109.50. That's how violent the market was just 2 weeks ago. But you also got an oversold buy signal. Now, Boeing, quality, you're buying quality. These are blue chip stocks, bullish power gauge, strong earnings potential. And again, you had a signal right after earnings back here. This is a pattern very similar to Michael Kors where it spiked up. You want to buy that first pullback. That's your oversold buy signal. Then again, right after earnings, and in the middle of this decline, you could have bought Boeing under 320, watching it go back all the way close to 360. And then finally, Intel, semiconductor stock, reported a blowout quarter. Notice that you had a buy signal about a week and a half ahead of earnings, and the stock spiked up just before the market peaked. But then it pulled all the way back, giving you a second chance to get into it. And you could have bought the stock at 42.5 and watched it rally almost immediately to 46.50. So in a period of market stress, you want to use the discipline, ignore the headlines, and plow into these stocks. Now, we got this testimonial from one of our early members. In 5 business days that I've been using Chaiken, I had a 10x return. Now, he was using options, obviously. These initial results are nothing short of astounding. Please extend my thanks to the entire Chaiken team. I mentioned earlier that my wife Sandy and I started the company. We're now 26 people in Philadelphia, here to help you. And this is an effort that really has gathered momentum, with the members being very happy. Now, I'm going to show you a different way to use Chaiken Analytics. How many of you are familiar with Monty Python? If you are, type a big M in the question box, please. And whether you're young or old, everybody has seen one of the movies or watched the series on TV. I'm going to show you a different way to use Chaiken Analytics. Last week, on Wednesday, my wife Sandy and I went out to dinner. We walked about 5 blocks in Center City, Philadelphia. We passed a Shake Shack along the way. And I said to Sandy, oh my God, there's nobody in this restaurant. It was 8 o'clock on a Wednesday night. So I took a picture. I actually sent it to Jim Cramer because, as you'll see in a minute, the power gauge rating was bearish, and I knew he had liked this stock a year ago. And he responded and then quoted our opinion on the stock on Squawk Box, heard on the street on Friday, after they reported a negative earnings surprise. So here was the thought process. I sat down at the dinner table. I had taken a picture of an empty restaurant that used to have lines out the door when they opened. And I looked and I saw that the power gauge rating was bearish. We have a mobile companion to the browser-based version. And it had just had a bearish money flow sell alert. And we're due to report earnings on February 15th. So from my point of view, this was the ideal setup. I made it my bearish stock in a new market letter we're going to be introducing, separate and distinct from Chaiken Analytics, called Mastering the Bear. And the stock reported very, very disappointing earnings. It spiked up the day before earnings, and then initially spiked up in the aftermarket to 43.5. But today it was down to 36.70 at the low. Now, here's why you need Chaiken Analytics or some discipline, whether it's from Investors Business Daily, stock charts. I don't care where you have the discipline. Here's the news story 4 days ago. Shake Shack tumbles on cautious sales outlook, but Wall Street isn't worried. Well, they damn well better be worried if the restaurants are empty and they're planning on opening another 25 or 30 of them this year. This stock was selling at 80 times earnings, and same-store sales are going to be flat to down this year, even after a 2% price increase. So what I did here is what Peter Lynch used to espouse. If you see something, say something, in essence. You go into a store and it's mobbed with people, do a little bit of research, but buy it. He bought Legs pantyhose because his wife came home with those little eggs in the 80s, now part of Hanes brand. The point being, I started with an idea, empty store. I checked the power gauge, saw that earnings were due out, thought this is a low-risk opportunity. If they disappoint as they did, and the stock sold off from 41 all the way to 36, even as the market was rallying last week. So let's end the webinar by showing you how I then use Shake Shack to find other ideas, bearish ideas in the restaurant industry. We won the Best Ideas Platform at the Benzinga FinTech Awards last May, 19 other contestants in that category, and we won it for something we call our stock discovery engine. It's a way to find profitable stocks or stocks to trade on the short side based on something like a Shake Shack. So I entered Shake Shack today into the discovery engine. Shake Shack has a very bearish rating. It's a small cap stock in the food retailing, weak cash flow, and so forth. So what did I get? 5 other bearish restaurant stocks, including McDonald's, which is the big gorilla in that industry. So I immediately went to the McDonald's chart and said, this is great for the webinar. Why? Because you had a relative strength sell signal 1 day off the peak, bearish personality change, and the power gauges turned bearish. So if you weren't aware that McDonald's was a stock to avoid or look for put buying opportunities, you now know that because you entered Shake Shack into our stock discovery engine. Very powerful tool to find bullish or bearish stocks or swaps. So we've covered what we think you need to know to cope with volatility and profit in a period of rising interest rates. Everything we've been looking at is part of Chaiken Analytics. The core pieces are our 20-factor, multi-factor fundamental model, which combines fundamentals and technicals, and now our stock discovery engine to find profitable ideas in a heartbeat. In addition, the screener we looked at and the options ideas. So Chaiken Analytics is normally $2,195 for an annual subscription. As a webinar special, we'd like to take $300 off the price, reducing it to $1,895. And you get a lot more than just the charts, including my weekly market letter. ChaikenAnalytics.com/profits, and this offer is good till midnight Friday, February 23rd. You can email sales@ChaikenAnalytics.com if you have a question, or dial the number on the screen. And Joe Bicella is going to put the fulfillment page link into the Q&A box right now. Now, in addition to everything we've looked at, you get our intraday charts, so you don't have to go running back to your online brokerage platform to monitor the intraday activity, and alerts there as well, our earnings detail and our earnings alert indicator, and my weekly market insights. Plus, as a Chaiken member, you get member-only access to our weekly strategy webinar that Joe Bicella hosts with our market strategist, John Schlitz. Unlimited coaching, including one-on-one coaching if you want it and need it. And then our daily morning insights, which comes into your inbox around 9:15 before the opening. Now, Jim Cramer, who we've come to really cherish as a partner, talks about us on Off the Chart segment. We did a segment for him on the health stocks before our 1-hour webinar back in late January, and in that he said, I learned a long time ago not to be on the other side of a Chaiken trade. That's wonderful praise from someone who knows more about stocks than I'll ever dream of. So thank you, Jim, and I know we've got a lot of Cramer people on today's webinar. There's a nice synergy between the way Jim looks at the market and the way Chaiken Analytics looks at the market. So as an added inducement to get you part of the Chaiken community, become a member of Chaiken, like to take an additional $100 off the cost of Chaiken Analytics. If you subscribe by midnight tonight, the price is only $1,795, $400 off the list price. And one further fast action bonus: for the first 7 people who subscribe tonight, you'll get a one-on-one phone call with me after you've gotten up and running on the system, and Joe has walked you through all the ins and outs of getting up to speed. They usually last a half hour to 40 minutes. I love doing them. Our members who take us up on the offer love it. So by all means, act quickly and be one of those 7 people who gets that one-on-one phone call. With that, I'd like to thank you all. Hope you've learned how to deal with volatile markets, and turn it back to Joe to wind down the webinar.
All right, Mark, thank you very much. And thank you all, everyone here, for joining us. To reiterate Mark's offer, that is a full year's membership to Chaiken Analytics, $17.95 discounted offer. This offer is available for the next few days, but please make sure to join us. Tomorrow afternoon, we are hosting our next onboard session. This is perfect for each one of you. If you take advantage of Mark's offer, again, just go right to ChaikenAnalytics.com/profits. You can jump right through the registration process. Won't take very long at all, and we'll have you register for that onboard webinar. Perfect for each one of you. We're going to show you how to create a variety of different lists, understand our analysis, and really have you generating new ideas, whether you're managing a portfolio of long positions or if you're trading options. We've got plenty of content available for you here. So please make sure to take advantage of Mark's offer. You can give us a call at 877-978-6257, or just go again right to ChaikenAnalytics.com/profits, and you'll see the page on your screen here. In the meantime, everybody have a wonderful evening, and we will see you on tomorrow's onboard session.